The RBA has increased the interest rate again, and naturally the question that follows is whether this is still a good time to buy and invest in property, or whether it makes more sense to wait until things settle down. Your borrowing capacity reduces, your repayments increase, and the numbers that may have worked a few months ago may no longer feel comfortable today. Right? Property markets do not wait for confidence to return before they move, right? They are forward looking, and by the time conditions feel stable again, prices have often already started adjusting. So rather than focusing on whether rates are high or low, it becomes more useful to understand what this change has actually done to your position. They have not removed the opportunity altogether, but they have changed the level at which that opportunity exists for you. A strategy that depends on rate dropping quickly is not a robust strategy, and this is where discipline becomes a defining factor. If the numbers work at current rates, if the asset you are considering is supported by strong fundamentals, and if you have the ability to hold it comfortably, then opportunity still exists. Okay, so welcome to Smart Property Moves. My name is Michelle. In today's video, I want to talk about something that's on everyone's mind right now. The RBA has increased the interest rate again, and naturally the question that follows is whether this is still a good time to buy and invest in property, or whether it makes more sense to wait until things settle down, right? Now, instead of rushing to an answer, I want to slow this down and unpack it properly, because in moments like this, most people react emotionally rather than strategically. They hear that rates have gone up and immediately assume that the property is now too expensive or too risky, but that kind of thinking often leads to inaction, and it usually what causes people to miss opportunities that only exist in uncertain markets. To understand how to respond to this, we first need to understand what has actually changed. When the RBA increases interest rates, the intention is to slow the economy down by making borrowing more expensive, which in turn reduces spending and helps control inflation, right? From a macro perspective, that is what is really happening. But from your perspective as a property investor, the impact is much more direct and practical. Your borrowing capacity reduces, your repayments increase, and the numbers that may have worked a few months ago may no longer feel comfortable today, right? This is the point where many people pause and begin to question whether they should move forward at all, and the default response tends to be to wait. This is where a deeper understanding of how the market behaves becomes much more important. Property markets do not wait for confidence to return before they move, right? They are forward looking, and by the time conditions feel stable again, prices have often already started adjusting. So rather than focusing on whether rates are high or low, it becomes more useful to understand what this change has actually done to your position. Now, the most important shift, and this is where the entire conversation needs to be centered, is that the interest rates have changed your price point, right? They have not removed the opportunity altogether, but they have changed the level at which that opportunity exists for you. If you were previously looking at buying in a market like Brisbane at $900,000 or $950 to $1 million price point, the same purchase today may place more pressure on your cash flow and reduce your ability to hold property comfortably over time, right? This does not mean that investing is no longer viable, but it does mean that continuing with the same plan without adjusting for current conditions can create unnecessary risk. Now, once you accept that your price point has shifted, your next step is not to step away from the market, but to rethink how you approach it. This is where experienced investors behave differently from first-time or emotionally driven buyers. Instead of trying to force a deal in a market that no longer aligns with the numbers, they begin to explore alternatives that fit within their revised capacity. In practical terms, this could mean looking beyond the inner parts of the city, or considering outer suburbs where entry prices are more aligned with the current borrowing conditions, or even evaluating regional markets where demand is supported by, for example, infrastructure, employment, and population movement. The decision is no longer driven by a preference for a particular location, but by whether the asset makes sense based on both current conditions and long-term potential. right? Now, at the same time, right, the importance of cash flow becomes much more pronounced in a higher interest rate environment. When borrowing was cheaper, investors could afford to take on tighter deals with the expectation that growth could compensate over time. In the current environment, that margin for error is reduced, and it becomes essential to ensure that the numbers work from the very beginning, right? This involves looking at repayments based on your current rates rather than optimistic projection, understanding rental income realistically, and factoring in how tax may offset some of the cost. Most importantly, it requires asking whether the property can be held comfortably over the next few years if conditions remain similar or even tighten slightly. A strategy that depends on rate dropping quickly is not a robust strategy, and this is where discipline becomes a defining factor, right? Now, interestingly, while higher interest rates create pressure, they also change the dynamics of the market in a way that can be advantageous for those who are prepared. As borrowing becomes more expensive, some buyers step back, which reduces the competition. This often leads to more balanced negotiations and provides buyers with the time and space to make considered decisions rather than reacting quickly in a competitive environment, right? In contrast to the conditions seen during periods of low interest rates where multiple buyers were competing for the same property, the current environment allows for a more measured approach. This again does not eliminate the risk, but it does create a different kind of opportunity, one that rewards patience and gives you clarity. Now, when you step back and look at the broader picture, it also becomes clear that long-term drivers of the property market have not fundamentally changed, right? Australia continues to face a shortage of housing supply, and population growth remains strong, particularly in key cities, right? These factors continue to support demand over the long term, even if short-term conditions fluctuate due to interest rates and economic cycle. What this creates is a situation where there may be temporary pressure, but the underlying direction of the market remains supported by structural factors. Now, bringing all of this together, the question is not whether it is a good or a bad time to buy in absolute terms. The more relevant question is whether your current position, your adjusted price point, and your strategy are aligned with the market conditions we are in today, right? If the numbers work at current rates, if the asset you are considering is supported by strong fundamentals, and if you have the ability to hold it comfortably, then opportunity still exists. On the other hand, if the plan relies on conditions improving quickly or stretches your capacity beyond a comfortable level, then it may be worth reassessing before moving forward. Right now, what is important to understand here is that every cycle introduces a different kind of challenge, and it also presents a different kind of opportunity. The investors who tend to perform well over time are not those who wait for perfect conditions, but those who are able to adjust their strategy as conditions change. In this case, the adjustment is not about abandoning the idea of investing, but about recognizing that the price point you operate in has shifted. Right now, if you found this useful and you are trying to understand how this applies to your own situation, whether in terms of borrowing capacity, price point, or identifying suitable areas to consider, feel free to reach out. These decisions are always specific to your individual circumstances, and having clarity around your numbers and your strategy can make a significant difference in how you navigate a market like this, right? And this is exactly what we do at FPW Group. Thanks for watching. I'll see you next week.